Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, where I continue my conversation with Chris Cruden, founder and CEO of Insch Capital Management. I mean, you've looked at obviously many different indicators over time, I'm sure, and I'm just curious in general. I mean, again, if we were going to help sort of the listeners and maybe the people who are aspiring to become a manager of funds at some point in their career, are there any indicators that you feel are more robust than others?
The only input we take for our system is price. So we really don't look at indicators per se. Other than the ones I previously mentioned, volatility and whatever measure you're using for momentum or breakout or that sort of thing. Indicators, I wouldn't even describe anything we do as being an indicator per se. It either is or it isn't. Right.
And when you get your signal, do you go all in one go, or do you scale in or scale out?
No. First of all, if it's an existing account, an account that's already up and running, in other words, fully invested at the prescribed leverage, we would describe them in terms of units of risk. So our system can be flat. In other words, it can have no position. Right. Currently, we have 4 flat positions. Okay. It can be long 1 risk unit, long 2 risk units, or short 1 risk unit, or short 2 risk units. Yeah. And that's it.
And in terms of I guess that's a little bit into sort of the risk management side. Can you maybe visualize a little bit about how much, or maybe I should even say how little risk you actually take when you get these to sort of a risk unit? How much risk does that actually represent?
Not very much. I think the maximum is something like 0.3 of 1% of the available capital per trade. Yeah. So we don't sort of think this trade is an absolute winner, let's really load up on it. That's just not what we do. And the reason for that is, as previously given, we simply don't know. Yeah. So you can make us cry, and might even make us bleed, but you're not going to kill us.
Sure. What about stop losses? What's your view on that?
We don't have stop losses in the market, and there's a historical reason for that. We do, of course, have stop losses, and it is spot, so there's never been an issue. They're not particularly tight because we only trade once a day, and we don't trade every day. So, we're not looking for that 1 or 2 pips that some sorts of systems are apparently seeking. So there is some sort of wiggle room for us. Our stops are based on time and volatility. So that's what takes us out there. We know what they are, but in the olden days, when you used to call Sid on the desk in London, Sid would want to know where your stop is, and that's because in the olden days, his job was to know whether you were a buyer or seller, and if possible, to trip your stops. So as a consequence, and as a part of building a system, we don't put stops in, because then you've got people who see them, and we take the view that there's no benefit in leaving any kind of footprint in the market, and that would include telling somebody where your stops are.
Sure. When you say you use time in your stops, do you mean that you have pure time stops, or is it just the fact that time is a component in the way you calculate the stops?
It's a component. It's not a calendar time or an hourly time or a daily time, anything like that.
Sure. Now, I think a lot of people, a lot of investors and people looking at this industry, I think they focus a lot on the buy and the sell as being really the crux of the matter, and this is how we make our money and so on and so forth. But I think a lot of practitioners would say that probably a very important factor in what we do is the position sizing itself, which is obviously part of the risk management. What's your view? Is position sizing part of the secret sauce to your success?
We look at the trades in a slightly different way. I mean, if you're talking about working the order, is that what you're?
No, I'm talking about the position sizing, meaning that, as you rightly say, you incorporate volatility, you incorporate certain other things, and that means at certain times, I would imagine, you can take on a large nominal position with a tight stop, or you can have a smaller nominal position with a bit looser stop. And that position sizing elastic, so to speak, actually becomes very important in the generation of returns over time, meaning, I guess in the old days, you would probably, maybe you remember this as well, that some managers would simply just buy 10 contracts every single time with no respect to what the environment was. And I think probably some of these managers got killed along the way. But nowadays it's a little bit more sophisticated than that. And I don't know whether in your model that's a big component of your return and your risk management, or maybe it is, in your case, more the point of entry and exit.
Well, for us, the position size is a function of the account size and the leverage, and because we trade spot, I can see in some markets, equities for example, you would have a definite limit on how much you could buy or sell at any one time. In the market we trade, that's really not a factor for us. Therefore, it's not a huge part, or indeed any part of the algorithm. Sure.
And the trade implementation itself, is that you run your systems once a day, or is it intraday, or how does it actually work?
Well, actually, we trade once a day, and that's at London 1 p.m., which is the deepest, most liquid time for FX. We could run it in real time, or we could run it 2 or 3 times a day, but we just don't. We haven't found through testing that it makes any enormous difference one way or the other. A good day for us, for example, is when we don't make any trades.
Yeah.
Because that means that what we've got on is working.
Sure. I want to shift gear on you a little bit and talk about risk management. How do you define risk?
How do I define risk?
Or what kind of risk measures do you look at? What's important for you when you look at risk? I mean, some people look at, value at risk. Some people look at, how much can I lose if everything goes wrong right this minute and my stops are triggered? I mean, how do you? What's the important number in your view?
We use a number which is sort of index risk, which is a calculation of what would we make or lose if we hit all of our stops simultaneously.
Right.
Now, it's not real, because you can't hit all of your stops simultaneously. It's not possible in a system like ours. But let's just say that if you hit all of your stops simultaneously, how much would you make or lose? That's a number that we do look at. As I say, our problem with our kind of system is not a catastrophic loss. That's simply something that really isn't going to happen to us. What is likely to happen to us is that we get an accumulation of small losses over an extended period of time, because we're risking so little on each trade, even at 3 times gearing.
Yeah.
It's hard for us to get hurt terribly, but nevertheless, we still like to know on a daily basis or on a real-time basis what our total risk to stop is if we would hit it, notwithstanding the fact that it's actually not possible. And we know that not only in terms of percentage of the portfolio, we know it in terms of percentage of the specific trade, and also in the number of pips. For example, I can tell you our Aussie yen position with short 2 risk units at the moment, we're up a total of 167.6 pips, which basically works out to about 1.749% of what we, and I'll use the word bet on that particular cross, and our risk to stop is a positive 67.45. So if the price came against us about 67 pips, we would still have made 1% on the money that we'd risked on that particular cross, just over 1%. Sure. That's the way we look at it.
Sure.
But having said that, the question might arise, well, what if you saw a truly horrific number? What would you do?
Yeah. Thanks for asking you.
You've got question. A fire alarm, so what do you do if you not just smell smoke, you see flames?
Sure.
The answer to that is, first of all, it's never happened. It would have to be an error within the program, because it's not possible for us to accumulate that kind of portfolio risk.
If I was going to ask you on a daily basis what range you would expect the loss to stop to be, sort of on average, long term, what kind of number would you expect to see when you look at your report every day and say, yeah, okay, we can lose 5%, or we can lose 7%, or we can lose 15%? I don't know. What is these acceptable sort of risk levels that you look at?
I can tell you this. Between a gain of, and this is at 3 times gearing.
Right.
3 times gearing.
Okay.
Between a gain of 1.25% and a loss of 1.25%.
Okay.
98% of our days, portfolio days, fall within that band.
Okay.
And at the extremities, it is very much positive, and they far outweigh the extremity on the loss side. So if you contrast that, for example, with the S&P 500 using the same 1.25 gain, 1.25 loss, the S&P 500 is about 74% of its days fall within that band. Therefore, you would say that it is far more volatile than our program, and indeed it is.
Of course, sure. Now, again, a question out of ignorance, I guess, and that's something to do with correlation. I mean, many diversified managers, look at correlation as an important component in terms of the diversification of the portfolio. But when you operate within one asset class, if we call it that, how does correlation, if at all, play in your design of your strategy? Or risk management, for that matter.
In terms of correlation with other asset classes?
Oh no, in terms of the internal correlation, because obviously, again, we're still dealing with 7 different currencies, but we're just mixing them up here. But I wonder whether the correlation between these 7 different currencies play any part really in your risk management, or in your research, in your design.
They do indeed. In fact, they play a big part.
Okay.
Because we cast your mind back into the world that existed before the euro.
Right.
We used to trade at Tamiso 28 different crosses, if you will. But we only traded Deutschmark for Europe. We traded pound, obviously, but we didn't trade guilder, we didn't trade lira, we didn't trade anything. And the reason for that is, at the very time that you needed diversification, what you actually had was one position effectively highly correlated with the Deutschmark. It's 7 times as large as you wanted it to be. Yeah. So as a proxy for Europe, we only traded the Deutschmark. Right. Correlation is very important to us, because that sort of correlation is something that can change very quickly, and with a little bit of experience, you see that it's something that generally comes along at the least helpful time. So if you find that you thought you had 7 positions, turns out you got 1 position 7 times as large. Yeah. And that's not good. So correlation, even in the price stream, the 16 price streams that we trade, is an important consideration.
And how do you deal with that other than having a stop for each of the? I mean, is there any other way you can deal with that unknown?
We do it with the risk equivalency.
Okay.
Risk equivalency, because we don't know.
Yeah.
We don't know. I think Larry Hyatt was in Market Wizards 1 years and years ago, and he was asked, or he said to Jack Schwager, he said, "I've never made a bad trade." And of course, everybody sort of leapt upon that and said, "What an arrogant son of a gun he was," which Larry wasn't or isn't an arrogant son of a gun. But what he was saying is, all trades are the same.
Yeah.
No trade is good, no trade is bad. Some might go on to be winners, some might be losers, but they're all basically the same at the time of instigation. So too with us. So we try and equalize everything. Because we trade the way we trade because of what we don't know, not because of what we suspect we know.
Yeah, absolutely. I want to shift to another topic, which is drawdowns. And, most managers, especially in sort of the CTA space, they actually spend most of their time in a drawdown of some sort. And, I'm not so sure that that's necessarily the case for you, but it is a big part of the story. And I think it probably also is a big part of what people pay for, is for the manager to be that filter and deal with the emotional roller coaster that it is to be in a drawdown. I'd love for you to share some of your experience in terms of how you deal with drawdowns. I know you have a lot of emphasis on being able to show up, and therefore clearly trying to be in deep drawdowns, I guess, is part of that. But how do you deal with that in general, and the periods when you go through your own drawdowns?
You mean as an individual, as a person?
Yeah, and in a sense, yes, because obviously that's what's reflected also in sort of your strategy.
As a real life human being with admittedly low levels of empathy, I would say that it's hard. But when you go into work every single day and there's remorseless losses, you lost 10 basis points today, you're up 5 tomorrow, you lost 15 the next day, and on and on and on it goes. Yeah. You would have to be inhuman or subhuman not to have it an effect.
Sure.
But this is the testing period that markets don't just test systems, markets test people. And people make the mistake that markets are here for our entertainment or our enrichment. They're not. They markets exist to teach humility, and they're really, really good at that.
Sure.
Really good at that.
Yeah.
But this is where you've got to just have the confidence to show up and keep spirits up and soldier on. That's what you do. What else are you going to do?
Do you have any personal rituals, if I could use that word, that you do to take your mind off that? I mean, some people we know, people that I've been speaking to, they use meditation, they use other certain things to just help them get clarity and get some of the emotions. I know we use computers to take the emotions out, but we can't take them out completely. But is there anything that you do to help yourself? Not myself. What I like to think that I do is for our younger people who have not seen this before. Right. I like to think that I am able to show some calmness and an injection of good humor. I think a sense of humor is sort of important in this business and is often lost. But that's what I try and do, and if I focus on that, then it automatically takes care of whatever concerns I might have as simultaneously. What do you learn from the drawdown periods? Because I think it's common in most industries that the difficult times are often the times where we learn the most. What has been your experience? Not necessarily just from the time with Contillo, but maybe also historically, what have you learned from the difficult times and the drawdowns? What I learned, well, let me answer this question by this way. I learned almost everything I need to know about this business and trading in the army. Okay. I learned the importance of discipline. Right. I learned not to panic. Mm-hmm.
and I learned a more than healthy disregard for hierarchies. So when a drawdown happens, as I said earlier, it's there to teach us humility, which we can all from time to time benefit from. But it's like running a marathon. It might hurt for a couple of hours, but it does end. I don't know when it will end, but it will end. I have complete and total confidence in that. There is not a sliver of doubt in my mind that our system earns returns, positive returns over time.
That confidence, Chris, is often a confidence that investors don't share because they very often pull out of a manager right or very close to the bottom of their drawdown. How do we, as managers, how do we transfer some of that confidence? What are the things that we need to become better at in order to give investors that confidence, do you think?
I think, and what we try to do here, is we show that we have not lost our discipline or our shape. We are not panicked by what is going on. We are aware of what's going on, but we have made a commitment and a representation to take certain action every day in the same way. And that's what we do. Now, investors notoriously buy at the high and sell at the low. That's an issue for them. That's them losing discipline. That's them losing panic. That's them having a mandate that requires them to take action, or for whatever reason, I don't know. But from our point of view, we will absolutely keep the faith. And as I mentioned earlier, I think that you'll find people who may 4 years ago have described them as systematic trend followers now currently be describing themselves as volatility traders in currencies. Why? Well, because clearly the world perceives that systematic trend following in currencies isn't working, but volatility guys are getting allocations, so I might as well call myself a volatility guy. And they may indeed even have made changes to their system, their approach, their program, whatever, at precisely the wrong time. That's not what we do. In the first flush of youth, many years ago, we would say, or I would have said, everybody should have all of their money in the currency markets because look how well we do. As I have aged and matured somewhat, I would say that's probably not the case. There is a time to be more exposed to certain assets than at other times. As long as the asset is liquid and transparent, then you should have some exposure to it. I'm sure. And as we said earlier, that in terms of liquidity and transparency, there's very little that beats the currency markets. So I'm not responsible. I can't help what actions other people take. I'm only responsible for what actions I take, and we follow the system. Yeah.
Now that confidence, and in a sense, if I asked you if you ever doubted your system, you certainly, I'm sure, would say no in terms of recent times. But I remember from my conversation with Jerry Parker that Richard Dennis taught them to learn to love their system. And essentially that's what I think you're saying, that you love your system, you love all of the characteristics of it, the ups and the downs and so on and so forth. But I'm curious, at what part in your career, how long did it take for you to realize or to come to that conclusion that you can have 100% confidence in this kind of approach? What triggered that, where you today can say, I have no doubt that we're going to be making money going forward? Because that's not something you get from day one when you start in this business, that I'm almost pretty sure of.
Yeah, I think our system as it exists is, and I mentioned earlier how simple the system really is. It's right. In a way, it's an encoding of old traders' cliches in many ways. Right. And these cliches, from the day that I entered this business, have been seen time and time again to be proved very generally very true. Not always, but very generally very true. And so even when we started the new system, or indeed the Kintyre system at Tamiso, we knew that the basis upon which it was built was true. For example, I mentioned earlier to you the length of winning holding periods versus losing holding periods.
Yes.
Losing holding periods, 6 days, winning, I think 16, 18 days, whatever it is.
Sure.
What is that? Well, that is cut losses, run profits.
Yeah.
That's what it is. Now, we all know that that's what works. So we look at a vast amount of statistical data on the system. For example, our system, some people might find this horrific, some people might not, but our system basically makes, of all of its trades, about 60% or so of them are losing trades.
Yeah.
About 40%, well done, are winning trades.
Sure.
But when we win about $2.12, $2.20, depending on how well we're doing, $2.22 more than the dollar we lose 60% of the time. That is our statistical edge. It doesn't happen on every single trade, but over the fullness of time, that's what happens. It's always happened. Now, if you and I were to sit down and say, well, let's design the world's greatest trading program, something with, say, a win-loss ratio, not of 60-40, losers over winners, but how about 50-50? If we could do that, 50-50, with a 3-to-1 payout, we would have all the money in the world. Sure. I don't mean a lot of money, I mean all the money in the world. Sure. Sadly, we haven't been able to do that. What we have done is 60-40 with a $2.12 over a dollar.
Yeah.
And that's statistically, from an investment point of view, a sufficiently high enough edge to make our system one of the best performing currency systems in the world.
Sure.
That's all. It's not because we get anything particularly right. It's just the way the numbers fall.
And of course, what you describe there is, of course, the essence of trend following. And we can go back and we can demonstrate track records from, Bill Dunn, Campbell, Chesapeake, whoever they are, and they're still around, and they've been doing this for 30, some of them even 40 years. And as far as I'm aware, a lot of these people right now, as we speak, and coming up to October of 2014, they're making all-time highs.
Yeah.
Yet, the death of trend following has been written so many times, and in fact, in recent times. So I want to take the opportunity when I speak to someone like yourself who've been around for a long time, and I probably ask this question from many of my guests, because I want to try and help explain or explore, why is it, do you think, that investors find it so difficult to accept this proof, these facts? These are not story, these are not marketing hypes, these are proven statistics, proven numbers that are far beyond in terms of robustness and certainly longevity when you compare it with almost any other investment strategy. Why do you think it is so difficult for them to believe in them? Because I think that's what they don't do, since they're all sitting on the sideline cutting CTA exposures, or certainly not putting money into that area.
I think we've kind of skirted around it before, but never actually said it. So it's a well-asked question. The fact of the matter is, they themselves lack the primary characteristic that makes trend followers successful, and that is discipline. They lack discipline. They are unable to, for whatever reason, hold or keep the faith.
Right.
That they bail at exactly the wrong time. So, and that's not going to change for these people. There's nothing you or I could say that is going to prevent them from doing that. And there's all sorts of reasons. I mean, there's job prevention or job protection. There's all sorts of reasons they have to do this. So, that's the way it is. I think it's unfortunate, but for them, For me, I don't care if they do or they don't.
Sure.
That's their choice. But it is unfortunate. And they'll all come flooding back in. And what you find is, of course, people will see a sudden flow of money towards, in this case, trend followers. They'll describe themselves as trend followers. They may or may not be. There'll be one or two disasters or blow-ups, and then the bruised, battered, and bleeding will stagger off and say, "I'm never going near those trend followers again." and
Sure.
the game goes on.
Sure. No. Interesting. Appreciate that. Now, I had one more question just about drawdowns and risk management. And, we all try to eliminate as much risk as we can or control it to certain acceptable levels in any event. But of course, as we know, not all risks can be modeled and can be programmed. So is there anything that keeps you awake at night? Some kind of risk that you know is out there, but you just nothing you can do about it that you might worry about from time to time? Maybe not every night.
One of the fortunate things about currencies is that we have the black swan, which is an event that can happen at any time, and who knows what. There is, of course, the 50-50 chance that we could be on the right side of that for whatever, such is the benefit of the bidirectional markets of currencies. And also due to the liquidity that we can soon get on the right side of it. So that sort of black swan doesn't worry me at all. I really can't envisage one, having been through all sorts of things, the Asian crisis and when Malaysia closed the sort of payout window at the casino on the ringgit and all of this sort of stuff. No, sort of been there, done that, got that T-shirt. That's fine. The grey swan. That is an event that everybody knows is going to happen, but they have to keep going until it does happen. And then they say, well, for the stock market, for example,
right?
You would say the stock market decline of 10, 20, 30, 40, 50%, which is done twice already this century.
Sure.
Will that happen again? I don't know. But if it does, people will say, aha, I knew that was going to happen. So we would describe that as a grey swan. For us, again, due to the particular asset class we trade, and specifically to versus stocks, as said, that would actually be a happy day for us. But
sure.
So do I sleep well at night? The answer is yes.
Sure. Now, research, on a more positive note, I guess, research is something which is kind of interesting because many investors want a manager to continue to innovate and do research, yet most people don't want you to change. So it's kind of a little bit of a contradictory objectives there. But how do you view research and how do you go about doing your own research?
We have two kinds of research that we do. The first is sort of general research, which are things that interest us, which are areas that we sort of poke our nose in to see if this is a good thing or a bad thing, an observation, if you will, on equities or fixed income or the SNB holdings of euro, whatever it is, that sort of thing. That is something that interests us, and it might or might not have a bearing subsequently on the markets that will affect currency prices. So that's one. The other area, of course, is specific research pertaining to the system itself.
Yeah.
So although I say we don't change the system, and we haven't, we have added other price streams. So we started off with 10, we now have 16. We're continually looking at others. We look and toy with, but never include in the portfolio, emerging currencies and other ways of trading, these sorts of things. And we research that sort of thing. And we keep very, very, very close statistical measures of what the system is actually doing. We sort of see it as a living, breathing organism. Because in a way it's a matrix that sort of changes every single day or with every single tick. So our research, to a large extent, our daily research, is focused on that. It's like running a nuclear plant, for example. You've got to keep a close eye on it, and we do. So there's two different kinds of research that we involve ourselves in.
Sure. I mean, you say you look at these emerging market currencies, but yet you don't trade them. But do I sense something of an open door saying we may one day include them, or we're not going to include them, we just look at them?
Well, we look at them to scratch our heads and say, well, why does anybody trade them? As I mentioned, the main input for our system is price.
Right.
And the reason for price is we can measure price. Price is the price. You like it or you don't like it, it doesn't matter. It doesn't change the price. If you can't measure it, you can't manage it. That would be a basic view of our business, I suppose, not just the trading system. With so-called emerging currencies, you have other kinds of risks.
Sure. Political
risk being one of them, and various other things. We can't measure those. Now, I'm not saying they can't be measured. I'm just saying that we can't measure them.
Yeah.
So we're not going to do anything we can't measure.
Sure.
Maybe other people can. And maybe emerging markets all shoot up and you make a ton of money because you're more geared than the guy next to you. But the fact that they've shot has really nothing to do with you. You didn't make them shoot up. You were just along for the ride. And when they shoot back down again, what are you going to do then? And that's the sort of the history of investment management in many ways. People who were in the right place at the right time. Emerging markets and emerging currencies, I feel pretty much the same way. I mean, I wouldn't feel comfortable knowing that if you smell sort of fire in a theatre, you want to be sitting next to an exit, and sure. I don't know where the exits are in those things. And what I do know is the exits are pretty narrow, as opposed to the G7 currencies, and so I don't want to be sitting in that theatre.
Sure, fair enough. A question I often get from the listeners, actually, and something that they have a deep interest in, and that's very simple, actually. When you do research and when you look at your models, what might trigger some kind of a yellow or a red flag in suggesting that maybe this model is not working as it should and it requires a tweak, or maybe requires more than a tweak? What are you looking for?
That's an interesting question. In order to sort of gain your badge of inclusion in the portfolio, the currency stream itself has to pass a battery of tests in terms of its liquidity and this, that, and the other. Now, once it's in, and we don't put them in straight away. Obviously, they are sort of paper traded in parallel for an excruciating long period of time, and then they're tested with house money and because real money trading is very different to paper trading, and it's really different to client trading. So it takes a long time for us to put something in, and very often, by the time we get around to doing it, we've seen that this is, in fact, is not what we want to do. So we have a lot of false starts. More than you can possibly imagine false starts, but we're just not 100% confident, therefore we don't. To me, so I always used to describe the portfolio of currencies as like having a sports team, and they've all got their Super Bowl rings on, and they've all won the World Series, and they've all got their pictures with the FA Cup or whatever it is, and that's great. But you think, well, that guy is not playing terribly well. Maybe I should drop him and bring in this other new player. And then just as you're thinking that is in fact what you're going to do, that player, the existing player, goes on and scores 7 goals or hits 9 home runs or whatever it is. Yeah. It's the same in our portfolio of sports player currencies. A good example of this is the Australian dollar. I have no idea how many times we've come close to firing the Australian dollar.
Yeah.
And then, all of a sudden, he's your superstar.
Yeah.
And as I mentioned at the outset, we do what we do the way we do it because of what we don't know, not what we like to think we know, or what we suspect we might know. So it is what it is.
Right. I want to jump to the next topic, which is a little bit about the business side of your firm. And I just want to, I think both you and I know that many people, if not most people in our business, do very similar things, but some as you've alluded to before, some are better at dressing it up and attract investors. But how do you try to stand out from the crowd, so to speak, in order to attract your investors?
From about 2000 to 2006, we sort of dropped out completely. We didn't make any effort at all.
Right.
From about 2007, 2008, we noticed that we were, I don't know other way to say it, substantially better than some of our peers. And so we've made a number of forays into marketing, all of which have been disaster. We've had, on occasions, one or two people working directly for us. We've had third-party marketeers. We've done all sorts of things. But the problem with it is entirely me. The reason we failed at that aspect is because of me. Because I lack confidence in somebody else making representations about us.
Right.
In order to get a paycheck. That's basically what it comes down to. Because I'm the person who have to live with that representation, not them. So that marketing has always been a disaster. It's one of the things we've done really, really badly. Now, how do we distinguish ourselves otherwise? Well, we try to produce the best numbers we can,
right,
and we tend to outlive our competitors. So maybe it's a naive belief. Probably is a naive belief, but over time, people have in fact noticed that. We don't have, big golf tournaments, and we don't do, fly people around for parties, and we don't host conferences and all that sort of stuff, because, as I mentioned at the very outset, doing things the way we do things, we don't in fact think of ourselves as being particularly intrinsically interesting people. Because what they really want to know, what they really want you to tell them, is tomorrow's prices. And we don't know tomorrow's prices.
Sure. And what about the flip side of that? Meaning, okay, maybe you haven't done much in terms of attracting new investors proactively. Maybe they have found you. But through a difficult period generally in the industry, even client retention has become a difficult thing for many managers. We've seen billion-dollar managers be cut to $50 million managers. Without being specific, but what's been your experience in that?
We've had a particularly loyal client base, some of which have sort of predate Insch. And so they know over the fullness of time, and they have a realistic expectation of what can and cannot be done in this business, in our asset class. And so we haven't had a lot of difficulty in that. We don't have any retail clients, for example. And the clients we do have tend to be professional bank / real foreign exchange practitioners themselves. So that's been a big advantage to us. We don't have to explain to them why we trade currencies at the outset, and so their level of understanding has been very, very high because they know us very well. And so we've probably, I don't know how other people have done, but we've probably done better than most in terms of retention.
Now, you've also chosen to be, if I can put Lugano in that space, being a little bit outside the, in terms of location, a little bit outside the big busy parts of the financial centers. I know you have a representation office in London, but certainly from where the main part of the business is operated from, Lugano. Why Lugano, and what does it give you that makes you choose to be there?
When my wife and I first decided we were be moving to Switzerland, the obvious place to go was Geneva, but I don't particularly like Geneva as a city. I mean, maybe I shouldn't say that, but I don't. I don't like Zurich, and we happen to be sitting in Lugano in Piazza de Reforma here, and my wife said to me, well, this is a lovely place, why don't we just stay here? So we did. But in those days, it wasn't, as I mentioned earlier, it wasn't the intention to build the business again.
Right.
So what drew us to Lugano was quality of life, and we have all of the lovely weather. We have the passion of the Italians, but guess what? The place is run by the Swiss. This is brilliant, absolutely brilliant.
Yeah.
And so we're very happy here. But it was, and the reality is, we could be anywhere. We could be on Park Avenue, Park Lane, or in Lugano. It doesn't make any difference as to how we would run the business. It's just that the quality of life here is, in my view, very pleasant indeed.
Absolutely. It's lovely. I've got a couple more questions that I want to talk to you about before I go to the last section. And let's try this one, because I think it's interesting to also find out what you believe are the important questions. And therefore, I wanted to ask you, if you could ask a question of the next guest on Top Traders Unplugged. So I have two questions here. What would you ask them? And if I could add the caveat, for example, and say, what if that next guest was David Harding? What would you ask him specifically?
Well, if the guest was David Harding, I would ask him for some advice. David is I think, a specifically a phenomenal individual. Of all the people I've known in this business, he is the one person who has, and I'm sure you're familiar with his career, he has sort of made lightning strike more than once. And I mentioned earlier, some people just happen to be in the right place at the right time. Well, it's true you're better off being an idiot in the right place than a genius in the wrong place. I know that. But very few people can make lightning strike twice or more. He has. Yeah. So, and he's pretty much unique. He's a genius is a word that's often sort of thrown around willy-nilly in this business, but he would, I think, get a tick in the box from most people for that, as opposed to somebody who's just merely brilliant and passing through. That description does not fit to David. So if I was to ask David Harding any question, I would say, David, do you have any good advice for me? So that would be David. Other people, I'm not entirely sure, because without knowing specifically who they are, I wouldn't know, which is why the David Harding thing has caught me on the hop, but it's a question. I wouldn't know what I tell you one thing that was told me some time ago, and this is the sort of thing this is the talking heads on CNBC. It is this: free advice is always accurately priced. It's worthless. So
well, let me put it this way, and without revealing too much, my next guest is one of the founders of AHL. I can't reveal who it is, but
let me think. That could be really, really hard.
So there we are. Now, another question that I have for you, and that is, of course, that through all of your career, you've been through hundreds, if not more, of due diligence, questionnaires, meetings, phone calls, whatever they are. But I want to ask you, what is the thing that these investors or potential investors whom you're talking to, what's the one question that they forget to ask you, they don't know to ask you?
That is a really good question. I tell you, one of the things we do, which we've had quite a lot of success with for those to whom we've proposed it, is that if an investment group, if all things being equal, and it's a realistic probability, and they do in fact have assets to allocate or whatever, we will run in effect a dummy account for them. And that removes their fear, I think, to some extent, of algorithmic trading, which they all think is going to be some sort of HAL meltdown, or some enormous leverage or this. So over a period of weeks or months even, they can actually see the trades. And so a question that they might ask is, could I try it first? And the answer, and that's why we do these dummy accounts. We don't do it for everybody. We don't do it ad infinitum, but we will do it for a period of time, so you can see what it is you're going to be investing in, and by doing that, it it builds their confidence. They can see on their desk, in their trading room or whatever, exactly what we're doing on a daily basis.
How long would you run an account like that?
The longest we've done is about 6 months or so.
How was the reaction by the investors when they realized they would have made a lot of money had they not been a test account?
Well, in that particular case, that did happen.
Okay.
But it doesn't always happen.
Sure.
Because when I'm not necessarily saying, aha, you see, you're fools, you should have written a check and now you didn't, and now you're poorer than you would have been otherwise. That's not the idea.
Sure.
The idea is just to show them how it worked. What are they going to be seeing?
Sure.
What likely risk are they going to be? Our margin utilization, for example, is around about 2%.
Right.
So compare that to a CTA a futures,
sure.
Whatever. I mean, it's tiny,
sure.
A small bit of stuff.
Yeah. No, I fully understand why you're doing it. Actually, I think it's a great idea. I've never thought about it that way. But the reason I asked you the last question is, of course, these people are also human beings, and therefore we know that their emotions, and the greed and the fear and all of these things will play in. So I just wonder what the reaction will be from people who, obviously either they would have said, oh, after 6 months, I saved 5% because you lost 5%, or they said, oh, damn, I missed the 15% move in this, So I was just curious about it, whether you had seen some funny reactions over the years. But now, the last section, Chris, is really something I just call general and fun. It's a little bit of everything, where I just dive into your experience and also trying to maybe get a different side, that maybe you don't show in your normal DDQ, so to speak. But I wanted to ask you, the entrepreneurial gene, I mean, you've been sort of doing this for a while, but has it always been there? I mean, was that a big part of your quest, if I can put it like that, to say one day I'm going to run my own shop, or was it more coincidental that you ended up in this situation?
I wouldn't describe it as coincidental, more accidental in my particular case.
Okay.
I'm very fortunate because I happen to have been associated with people who are incredibly talented at every aspect of the business, even at a very, very young age. AHL. Right. These are truly gifted individuals in their way, and that's been proven by longevity and results.
Absolutely.
It's indisputable. And other people who've passed through AHL as an alumni, in my view, it is sort of dwarfs whatever achievements may have been made by for example, the turtles. I mean, the AHL was an extraordinary phenomena. Yeah. I was very fortunate, or some would say unfortunate, to be with Bob Tomiso, because Bob had certain views, many of which I took on board absolutely 100%, and some of them have been very helpful, and some of them have been less helpful in terms of my regard for people in various parts of the industry. It wasn't really my intention. And so as a consequence, I never really thought, gosh, I can do this better. If I was by myself, I could do this too. That's never really what drove me on or made me want to start up. I mean, I do this because I love it. I can't think of what else I would do. If I didn't do this, it would worry me. In fact, I used to have, this sounds silly, but back in the, around about the time of the Asian crisis, we were very successful and lots of money and all this sort of stuff. And it used to disturb me, and I would have dreams that I had lost all my money because somebody told me on the golf course that what I should be doing is opening a string of dry cleaners or something like that. And I didn't know the first thing about dry cleaners, but it struck me as a really good idea, so that's what I did, and I lost all my money. And that's the way to avoid that is to continue doing what I do know something about, which is this, and that's why I'm still here. I guess, as Tomiso would say, it's how we define ourselves.
Exactly, absolutely. Is there any book that you've come across through all these years that have made a particular impression on you and that you would recommend either people who want to become a manager or people who want to become an entrepreneur, people who want to invest in these strategies, something where you say, yeah, this is something that they should spend some time and read? Is there anything that springs to mind?
The obvious one, I suppose, would be the Market Wizards one,
Right.
Jack Schwager.
Yeah.
That's for traders.
Right.
If you're a trader, a trader is slightly different to an investment management sophisticated company that we have now. I suppose the Covell book, Trend Following, and that sort of book are always interesting. A lot of them are sort of war stories type books and
Sure.
glorification and glamorization of people, but they're interesting stories.
And why do you think, just if I may interrupt here, why do you think these stories are so important? What is it that they do for someone like yourself, and what you think it would do for others for them to read them?
Well, I think that you can draw certain conclusions, parallels and conclusions between yourself and somebody else. And what they say about themselves is always very interesting. Some people try and convince you they're a big hitter. Some people try and convince you, as we said, that they know tomorrow's prices. Some people, all that they're highly PhD driven and the world's most brilliant person and all this sort of stuff. Well, maybe they are, maybe they aren't. But you can sort of compare and contrast with what some of these trader stories actually say about them as individuals, which is interesting, because there are stresses and strains in this sort of business, which you've alluded to with your questioning earlier, that do in fact or can in fact take their toll. And the question is, how do you handle that? Can you handle that? Some people can't handle success. In fact, years ago, there was a cartoon in the New Yorker that Bob and I used to have framed in our offices in New York, and it was of two hobos, two tramps, surrounded by gin bottles and whiskey bottles and open pizza boxes, sitting in a back alley somewhere,
Right.
unshaven and unkempt.
Sure.
And the caption read, one saying to the other, the irony is I really could have handled success. And some people can't handle success. And that's where your ego thing steps in and becomes an impediment to, or changes your personality. People build an international headquarters, they get a second wife, they do all sorts of stuff. And that changes people.
Yeah.
And generally speaking, not for the better.
Sure.
And you see it in corporations as well. We could say that there's a very big company with three letters beginning with M that has changed itself.
Sure.
And for the better, I don't know. Time will tell.
Time will tell, indeed. Speaking about failures, you mentioned earlier what you perceived as being your biggest failure. And I think, if my memory serves me right, you were sort of referring to marketing or lack of it, maybe.
Yeah.
Tell me a little bit more about that. And what has it taught you in a sense, or how are you going to deal with that?
I don't think I'm ever going to deal with it successfully, and I've come to that sad conclusion.
Right.
As I mentioned, in this business, you're only as good as the representation you make, and I'm perfectly happy to make representations, which is virtually none. All we're going to do is do what the system says.
Sure.
Now, I'm not comfortable about other people making representations about me or about what we do here.
Right.
And I just can't. I can't let go of that. So I wish I could. But
so it's a control thing in a sense.
Well, our chairman is a man called David Anderson, who used to be the chairman of Man when I first met him at AHL years and years and years ago. And he recently just absolutely stunned me, completely floored me when he said, "You're a control freak." I'd never considered that, but I guess I am.
Right.
And now, in terms of the research and the trading, this, that, and the other, I have no issue with the people we have.
Sure.
But for some reason, handing over the representation part of my business is not something I'm at all comfortable with.
Sure.
And I don't think I ever will be.
Sure.
And it's cost us tens of millions. There we are.
Sure.
Isn't that sad?
Well, nope. We're all different, isn't? That's what makes you unique, isn't it?
Yeah. For better or for worse.
For better or for worse. Generally speaking, Chris, what's the most difficult nowadays that you have to deal with as a hedge fund manager or CTA, do you think?
Well, the obvious and probably accurate answer is regulation,
right?
Of which I am not a committed fan, I would have to say.
Sure.
My observation would be that this business has never been more regulated, more expensively regulated, or more incompetently regulated than it is now. And I see it getting worse, not better.
Right.
When I entered into this business in the early 80s, we were talking about financial disasters. We had continental Illinois, perhaps. Then we had the savings and loans. And then in this country we had, or in the UK, we had Barlow Clowes. And then Barings, God forbid. Barings was 800 million.
Yeah.
That's a rounding error these days. Now,
yes.
Each and every turn and twist.
It's a fine almost.
It is. It's half a fine.
It's half a fine, yeah.
You'd be clicking your heels if you were JP Morgan, got 800 million fine. But these days, and at every turn and twist, there's more and more regulation.
Yeah.
And it's just got worse and worse and worse. There's a direct correlation, talking about correlations, between the amount of regulation and the size of financial crises.
Right.
And it's there for all to see.
Sure. Which means the next few years will be interesting to follow, no doubt. Now, a couple of questions left, and then I will let you go. Can you tell me a fun fact? I know you told me a story earlier today, which actually was a bit fun, but it was before we pressed the record button, but I don't know whether that's the one you want to share. But anyway, can you tell me a fun fact about yourself that even people who know you well may not know about you?
I don't know if it's a fun fact, but most people assume that I'm brimful of confidence, but that is in fact not the case. I'm probably reasonably adept at covering it up, but I do get in terms of giving speeches or this sort of thing, for example.
Sure.
I'm very nervous.
Sure.
Which I don't think is the view that most people have of me.
No, absolutely not. But I think that's the human part of all of us, isn't it? That I think that it's been said, and maybe it's part based on research, that's probably apart from dying, our biggest fear is to go on stage and give a speech.
I love doing it. I'm always invited to do it. Yeah. And for whatever reason, I guess it's because they never know what I'm going to say. I might say, I don't have a corporate line to follow.
Maybe they're more worried than you are then.
Well, I hope so.
Anyway, great stuff. My last question, we talked earlier about today that investors might not be asking you the right questions and they fail to ask you certain questions. So I have to be tough on myself as well. And that is, was there anything that I missed today? Something I should have asked that I didn't ask? And just to make sure that I've done justice to you and to Insch? Well,
I don't think so. I'm astounded, impressed, and to some extent appalled at the depth of the questions and the knowledge behind them. So if there are, I wouldn't tell you because I wouldn't wish it on your next guest, especially if they're from AHL. No, I wouldn't make it any harder on them.
Great stuff. Excellent. Well, before we finish, do you mind telling our listeners where they can best reach out to you and to learn more about Insch Capital Management?
Sure. Our website is www.inschinvest.com. Our Insch is spelled with INSCH, so that's inschinvest.com. And we're based here in Lugano. All details, and indeed almost all of the materials that we have that would be of initial interest to a potential investor are available for download on the website. And we are delighted to show investors through a web presentation precisely how the system works, which I think is fairly unusual and unique. Most people try and there's some sort of mystique to it, but for us, we'll show you precisely how it works, and I think that is something we're very proud of. So we're happy to do it.
That's great. Yeah, I did notice that your website was pretty detailed, and of course, I will be also making links on the show notes page for these episodes with all your contact information so that investors themselves can reach out to you and and hopefully learn a lot more. So all I have to say, on a day when I know you're a keen golfer, Chris. So on a day, and this will reveal that we're doing this on a Sunday afternoon, but on a day where the Ryder Cup is taking place, I have to give you extra credit and say thank you ever so much for taking the time out to speak with me. It's been a great pleasure. I thoroughly enjoyed it, and I appreciate the transparency and the honesty in your answers. And I look forward to staying in touch and to hopefully connect again and hear how things are working out down in Lugano.
Well, thank you so much. I thoroughly enjoyed it, far more than I thought I was going to such an extent I don't even miss the Ryder Cup. Thank you very much indeed.
You're welcome. Take care, Chris.
Cheerio.
All the best. Bye.
Bye-bye.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.